now that we've looked at our assets, I would like us to look at our liabilities. This is also a term that is defined in your textbook as the company's current obligations, and these current obligations are also as a result of past events when you were borrowing money, maybe. So, due to past event. And the difference now here is that the future economic benefits we talked about, they are expected to flow out instead of in, as we seen with our assets. So, future economic benefits will go out. So this is also a fancier way of telling us about what a company owes. So these are just the debts of a company. So these are just the debts of a company, right? So now that we're done with the definition, I want us to look at the classification of liabilities. Same thing we did when we were looking at our assets, right? So with liabilities as well, they are split between two current liabilities and our non-current liabilities. So with the current liabilities, it's our longer debts. So those are the debts that we expect to pay for over than 1 year. So we're still going to pay them even after a year, the year has ended. So those are our long-term loans or our mortgage bonds. And then when our current assets are concerned, right, we are talking about liabilities that will be settled within the next 12 months after the year has ended, right? So those are our trade creditors, any bank overdraft that you have with your bank, accrued expenses or income received in advance, and the short-term portion of the loan, right? So I think this is one thing that I want to explain. So we did see with our assets as well that we did had a portion that related to fixed assets, to our fixed deposits that's longer than 12 months, and then the one that's less than 12 months. So what I am going to explain is going to apply to both of them, right? So let's say that in year one we have 3 years, year two and year three. So you owe your friend 10 rands here, 10 rands here, and 10 rands here. So in total, you owe your friend 30 rands, right? So now we are in year zero. So this is the current year, right? So what I want us to look at now is when we are here at year zero, this year one money, this 10 rands is going to be paid in the next year, which is within the next what? Next 12 months. So this will be regarded as our what? As our current portion of this long-term loan. And this other part on the other side will then be referred to as our non-current liability. So the split will be then we would have 10 rands for our current liability, and then we'll have 20 rands for our non-current liabilities, but the total of our liabilities will be 30. I hope this makes sense. So now let us also go to a ledger account of liabilities in order for us to explain its behavior like we did with the assets. So as I said, liabilities are basically an inverse of assets. So they would behave the directly opposite way with what we've seen with the assets. So liabilities, so debit side will always be on the left, it doesn't change. Credit side will always be on the right. But now, as I say that this is the inverse or the opposite of the assets, our liabilities will always increase on the credit side. So our increases for liabilities will be recorded on the side, and then our decreases will be on the debit side. So anything that decreases, our liabilities will be recorded on the side. So now let us go on and try to list the types of liabilities or transactions we might see increasing the liability account. So yeah, the first obvious one is when we buy on credit. So when we buy on credit, it means that we still owe someone. Somewhere, somehow in the future, we have to pay them back their money. And then the second one here would be when we take out a loan with the bank. So we still have to pay the bank back their money. And when we receive money in advance. So the theory behind income received in advance is that we still owe that person that money. they can still come back and ask for their money, or we still need to give them a good or render a service for what they've given us. And then here it can also be a SARS income tax that increases this account, right? And then what would then decrease our liabilities? So our liabilities will decrease when we pay what we owe. Pay what we owe, and that is when our liabilities would decrease and go down. So the reconciliation theory that we applied with the assets will also be the same with the liabilities. And again, I want to emphasize this. It is important for us to understand both the reconciliation and the ledger account, because of this reconciliation will really come in handy when we are trying to work out figures when our cash flow comes. So here we said we are going to have our opening balance, and then we would have our movements there, and then our movements will be the same. So anything that increases our liabilities must go there under our movements. But then if you remember, for our assets, these increases were every transactions on the debit side. But then for our liabilities, our increases will be transactions on the credit side. And then our decreases will then come from the debit side this time around. And then they would have our closing balance, same thing we did with our assets. And then there will be the figure there. And then here we'll have our closing balance. And then our account will be done. So our decreases there would have to reflect them as a subtraction or as a reduction in the account. And then increases would be an addition to the account. And that right there, ladies and gentlemen, is our liabilities. See you in the next section for our equity. Thank you.